So in today's video, we're going to talk about dividends, dividend growth stocks, and my personal strategy for building a dividend growth portfolio, not just for next year, but also, obviously for many, many years to come, probably for the rest of my life. But anyway, this video is going to be a little bit more on the educational side for beginners. So I apologize, if you're more advanced, I completely understand if you don't want to watch this video or anything, because it is kind of more for beginners. But at the end of the video, we will also look at some dividend growth stocks that I'm actually invested in, and then we'll also look at some other dividend stocks as well and just kind of compare and all that kind of stuff. So it might actually be a lot of fun. So anyway, with all that being said, let's go ahead and get started. What's up, everybody? My name is Ale and welcome to my world of stocks. Now today we'll be looking at cash dividends, so not stock dividends or property dividends or any other kind of dividends. We'll be looking at cash dividends, which are just basically payments made by a company to its shareholders as a way of rewarding their shareholders for investing in the company. Now, dividends can be paid quarterly, yearly, sometimes even monthly, depending on the structure that the company uses. Now, dividends are great for many different reasons, but if you're in the later years of your life, then you're probably looking for safe companies that have been paying out dividends consistently for a very long time. So we're talking, 40 years, 50 years. That would generally be the type of stocks you want to invest in for income purposes, if you want to get dividends as a source of income. So that would generally be considered something like a dividend income portfolio. But if you're in the somewhat younger years of your life, if you're kind of like me and you still have a long time to invest in the stock market, so time is kind of still on your side, then you're probably more interested in what we call a dividend growth portfolio. So you're looking more at dividend growth stocks. And we're going to get into all the different reasons in just a second, but just to give you a quick little summary, dividend growth stocks are essentially stocks that have a lot of earnings growth potential, and they also have the potential to increase their dividends over time, their dividend payments over time. And so if you're continuously, if you're investing in a company that is continuously increasing in share price, and they're increasing their dividends, and you're continuously reinvesting those growing dividends, then those are compounding gains that are gonna just keep adding up over time, resulting in huge profits. For example, I'm sure you guys have heard of Warren Buffett, right? So Warren Buffett bought $1 billion worth of Coca-Cola stock for Berkshire Hathaway back in 1987. And as Coca-Cola's dividends grew over time, his dividend yield also grew to over 60% on that original $1 billion worth of stock. So now he's making over $600 million a year just for holding that stock. And sure, that's if you originally invest, with $1 billion. Obviously, you probably don't have $1 billion. I certainly don't have anywhere even in the same universe as $1 billion. But who doesn't want to eventually achieve, a dividend yield of over 60%? That's very impressive, and it shows the power of dividend growth investing if you do it correctly. Now, I'm saying dividend yield. I should probably explain what that is really quick. So a dividend yield, that's just the percentage of the stock's value that will be paid out to you. So the higher the yield is, the more money you'll be getting back from your stock investment. So because of that, people will generally look for stocks that have high dividend yields so that they can get more money paid back to them from their investments. But as a dividend growth investor, I actually look for stocks that have lower dividend yields. I know that sounds crazy, but we're going to talk about this. But a stock having a low dividend yield actually means that they probably have more potential to increase those dividends in the future and just kind of add up to a much higher yield in the future. And because lower dividend yields are usually attached to growing companies, right? Because more established companies, they'll be paying out a higher amount of dividends because they don't really have anywhere to go. They might not have a lot of room to grow, so they don't have to really reinvest their money, so they can afford to just kind of pay out a lot of their earnings in dividends. But lower dividend yields are usually attached to growing companies, and because they're obviously reinvesting in their growth and things like that. But what that means is that because it's a growing company, chances are that stock price is also going to be growing over time. So you'll be getting value from two different sources, from the stock price appreciating in value over time and growing dividends over time that you're continuously reinvesting. So to give you a quick example, let's say that you invest in a stock that is worth $1. It's trading at $1 per share. Okay, now this is just an example, so don't like. Sometimes I give examples and then people like criticize me in the comment section. It's just an example, but let's say that a stock is trading at $1 per share, and let's say that they're paying out a 1% dividend yield. Okay, so pretty low yield. So a 1% dividend yield would be what that would be like one cent, right? So they're paying out a dividend of 1 cent. They trade at $1. It's a dividend yield of 1%. Now, let's say you buy that stock and so you own that stock. Then let's say that several years pass, and let's say that stock price goes up to, I don't know, let's say it goes up to $10. Okay, so it was trading at $1. Now it's trading at $10, and they want to keep that 1% dividend yield, right? So if they want to keep that 1% dividend yield, then they would have to increase their dividend from 1 cent to now 10 cents. Okay, so anybody who buys it at that $10 price, they're going to be getting a dividend yield of 1%, just like what you got several years back, and a dividend of 10 cents, 1% dividend yield. But because you bought that stock, several years back at $1 per share, then that 10-cent dividend is actually worth 10% to you. So while other people are getting a dividend yield of only 1%, your yield is actually as high as 10% because you bought it, a long time ago. Not to mention the fact that all the meanwhile, you've been reinvesting those dividends, and all the meanwhile, that stock price has been going up. So you've been receiving a lot of profits during all that time. And now you're at the point where your yield is at like 10%, while new investors are only getting like a 1% yield. So you can see how, it just quickly stacks up. And that's just if it gets to, 10%, but it could obviously go massively higher. Again, the example with Warren Buffett is that now he's getting a yield of over 60%, probably a lot bigger than that. So it can really start to add up. Whereas if you invest in a stock that already pays a high dividend yield, what are the chances of that dividend really increasing in the future, their stock price increasing in the future? It will definitely, most likely it'll still increase, but not at the rate as a growing company or a dividend growth stock would. And I mentioned reinvesting those dividends, right? So that's also a reason why a lot of people sign up for a DRIP plan. So that's a dividend reinvestment plan. And what that basically does is it just takes your dividend profits, your dividend payments, and it just reinvests them like in the same company that you're receiving those payments from. So that's one way that you could go about doing it. I personally don't use any kind of DRIP plan because I like to, first of all, I find the stock market a lot of fun. So I actually enjoy like keeping up with stocks and handpicking stocks and things like that. And at the moment that I receive a dividend payment, there may be a different dividend growth stock that is more attractive to me at that time. So I'd rather funnel that cash into the stock that I like the most at that time. So that's why I don't really use DRIP, but a lot of people like it. And if you want a more hands-off approach, then definitely a DRIP plan is something that you should look into. Okay, so now you might be wondering, all of that sounds really great. I'm hearing a lot of great things about dividend growth stocks and things like that. So what exactly do I have to look for when I'm looking for a good dividend growth stock to invest in? Well, when I first structured this video, I could tell, because when I structure videos, I can tell how long they're going to be based on all the different things that I'm going to talk about. And when I first structured this video, I could tell that it was going to be over an hour long, which is insanely long, and you guys would get bored and fall asleep. So I had to cut a lot of stuff out. I wanted to explain every single thing, and I wanted to go through all the little details, but I had to cut a lot of stuff out and make a few assumptions. So I have to assume that you know how to pick a good growth stock to invest in. And so that generally entails looking at the income statement, looking at the balance sheet, researching the company, making sure that they have a competitive product that gives them an edge over their competition, ideally in an emerging market. That would also be nice. That would help them keep growing in the future. Now, I've done several videos where I talk about all those different things, so I would definitely look at those videos as well, but you can also just kind of Google it and look at other videos also. Now, I will make future videos on those different things, like the income statement, the balance sheet. I'll tell you exactly what you need to look for, but those will be future videos, so you'll kind of just have to wait for those. But if you want a good place to start, I'll just give you a few websites that I generally use, and I think that they're good free websites that you can use to get a lot of information. One would be Nasdaq.com. That one's really good for looking at income statements and balance sheets. And I think they go back like a few years as well. You can look at 4 years of history. You can also look at some expected earnings as well. Speaking of expected earnings, if you want to know like the earnings growth rates and things like that, a good website for that one is simplywallstreet.com. So that one's pretty good for earnings growth rates, and they have a lot of other tools and metrics on there as well. And they also compare the stock to the industry, so their competitors, and to the overall market as well. So that's a really good website also. And then also I would recommend Fool.com. That's a really good one if you just want to learn about the company and know what they're doing and how they're performing. By the way, I'm not affiliated with any of these websites. I know I'm speaking very highly of them, but I don't have any kind of connection with them. I'm just suggesting them. I'll have links in the description below in case you need them. Okay, but for now, let's focus on 3 primary things that are more directly related to dividend growth stocks that I always look at when I'm trying to see, how their dividend performance is going, their dividend growth potential. These are things that I look at. So one is the dividend growth history. That's very important. The dividend's average growth rate is also very important, and then the dividend payout ratio. So I'm going to break down all 3 of these right now. Okay, starting with the dividend growth history. Now, obviously, it's very important to know the dividend history in general of a company, like how many years have they been paying dividends and what has their history been like. But it's also very important to see the dividend growth history. In other words, how many consecutive years as of recent have they been increasing their dividends, right? So is it 5 years? Is it all the way up to 50 years? Whatever the number is, the higher the number is, the better. Now, typically, I like it when the company has at least 10 consecutive years of increasing their dividends. That's pretty good to me. But if it's a really good company that has a competitive edge over their competition, then I am willing to invest in a company that has a little bit of a lower dividend growth history than 10 years. But generally for me, 10 years is kind of the sweet spot. But again, the higher the number is, the better, because that tells you that they have a long history of increasing dividends, and they may have even gone through a market crash and they actually increase their dividends even through a market crash. So it could potentially even give you a little bit of crash protection as well, if that's something that you're worried about. Okay, next up is the average growth rate. So we may know how many consecutive years they've been increasing their dividends, but we also want to know by how much. So we'll take the average percentage of those dividend increases for a specific amount of time. And if they're only increasing at a rate of 1% or 2%, that's pretty low. But if instead they're increasing their dividends at a rate of 10%, 20%, maybe even higher, then that's a really good thing. And if you're reinvesting those dividends, that's going to start to stack up. Now, one thing that you do have to be careful here is the specific amount of time that you're looking at, because if you're looking at like a 30-year, if you're looking at like 30 years of growth and you're taking the average of those 30 years, then you're taking in dividend increases from 30 years ago, and that's not going to be realistic or maybe even sustainable, right? If a company, if you're taking the dividend increases from when they barely started paying dividends, then you're going to have increases of like 100%, 200%, whatever like that, and that's not very realistic. It's not very sustainable, right? So you want to look at more recent history. So I generally look at the last 5 years. I'll take the 5-year average growth rate for those dividends. And typically I'll look for at least double-digit growth rates. So if it's like 10% or more, that's pretty good for me. If it's a lot less than 10%, then I don't really consider it a dividend growth stock, but over 10%, that's usually pretty good. Okay, and lastly, we have the dividend payout ratio, which is just the percentage of their earnings that they're paying out in the form of dividends. Now, there's a couple different ways you can look at this. A high dividend payout ratio means that they're spending more of their earnings to reward shareholders with dividends. A low payout ratio means that they're probably reinvesting in the company, so they're probably growing, reinvesting in the company, or even strengthening their balance sheet. Now, you might be thinking that you want a high dividend payout ratio because it's more of their earnings being paid back to you as an investor in the form of dividends. But the problem is that if they already have a very high dividend payout ratio, then there's probably not a whole lot of room to keep increasing those dividends in the future. So if you're paying a lower share price right now, ideally, and that stock goes up later, then you want the dividend to increase so that your yield increases along with it. But like I said, if the payout ratio is already very high and say the company starts to struggle, even, it's possible that the company could struggle, then how are they going to keep increasing those dividends, right? They may even have to take on additional debt, and then, that just kind of snowballs into a lot of problems. So ideally, as a dividend growth investor, that's fine if you're more of a dividend income investor, but if you're a dividend growth investor, then you probably want a lower payout ratio. Not probably, you do want a lower dividend payout ratio, because it means that there's more potential for them to increase those dividends in the future. Also, if their dividend payout ratio is low, that means that they're using a lot of their earnings to reinvest in the company to help them grow in the future. So, so if they're reinvesting or maybe even strengthening their balance sheet, they're using their earnings to really help the company keep growing, which is really what you want. And so for those reasons, I'll generally look for a payout ratio of 50% or less. Usually that's it's an arbitrary number, to be honest, but 50% or less is usually where I find most of my dividend growth stocks to be hanging out at in terms of the payout ratio. All right, guys, now it's time for the fun part. We're gonna actually start looking at some stocks, and I'm gonna show you how to look at those 3 different metrics that we talked about. Now, there are many different websites that you can use, and even different broker platforms have different tools and things like that, and a lot of them are very robust that you can use. But in terms of a free website, my favorite to use is seekingalpha.com. So all you got to do here is go to seekingalpha.com, type in the ticker symbol, click on the dividends tab, and from there you can use all these different sub tabs to get more information that you might need. And so I highly recommend that you use all the different sub tabs. But for the purpose of this video and to keep the video short, we'll mostly just be looking at the dividend scorecard, which is this tab right here. Now, just a quick disclaimer before we start looking at some of my stocks. I know some people might leave some negative comments saying that my stocks are not really the greatest, dividend stocks. And that's because I invest in stocks for their growth potential first, and then I look for all the dividend growth potential after that. Now, your strategy might be different. So you might like other stocks, you might be attracted to different stocks than the ones that I'm investing in, but that's just kind of my strategy. So I just want to throw that out there, let you know that the whole dividend side kind of comes second to actually finding a good growth stock. For me, that's just my strategy. Okay, so let's start with my number 1 largest stock right now, which is Disney. Now, their dividend yield is only around 1.5%, which is pretty low. Generally, with dividend growth stocks, you tend to look for like 2% or a little more. So this one is a little low at 1.5%. And then their dividend growth history, their years of dividend growth, is also a little low at only 9 years. Generally, we want it to be 10 years or more, but 9 years is still pretty good. And then they've also been paying dividends since 1989, so that's a pretty good history as well. And then their payout ratio is outstandingly low at only 24%, and they have a 5-year growth rate of 17%, along with a pretty good looking price chart for the last decade as well. So given that I love Disney stock in general because they have great price performance, they have a really strong brand, and they also have a new and very compelling product coming out soon with their Disney streaming service next year, I'm willing to invest in them long term, and I also consider them a pretty good dividend growth stock as well. Okay, now my second largest stock is Microsoft, and we've got the yield again pretty low at 1.6, and the dividend growth history is also a little low at only 8 years, but their payout ratio looks good enough at around 40%, and their 5-year growth rate is also pretty solid at around 14%. And they've been paying dividends since 2003, along with one of the smoothest looking price charts out there for the past decade. So with a competitive edge in cloud computing, PC computing and software, gaming, artificial intelligence, and many other emerging markets, Microsoft to me is a no-brainer that is not only a great stock to invest in for general reasons, but also another pretty good dividend growth stock as well. Okay, now another stock to look at here. This one's a little embarrassing because, well, you'll see their dividends aren't that great, but another stock that I'm invested in is Activision Blizzard. And the reason I like this one is because they're a gaming company and they're in one of the fastest growing, markets in the world right now. The gaming market is just like blowing up, and it's expected to continue to keep going up as well. But their dividend yield is extremely low at only 0.4%. So I know you're kind of rolling your eyes right now, but their dividend growth history is also a little low at 8 years, but then they have one of the smallest payout ratios around at less than 13%. So a really good payout ratio, and their 5-year growth rate is still pretty decent at 10%. And the thing that's really cool about Activision is that they've actually increased their dividends every single year that they've started paying them since 2010. And with the gaming market climbing at an enormous rate, with one of the strongest gaming IPs in Call of Duty, along with a new Battle Royale mode to challenge Fortnite, and a really solid price chart for the last decade, I'm once again left feeling like this is a great stock to invest in just in general. And then they also have the added bonus of paying out dividends as well that will probably continue to grow in the future. Okay, and let's look at one more stock that I'm actually invested in, and that's Taiwan Semiconductor. So this one is ticker symbol TSM, and they're a semiconductor stock, so you may want to be a little cautious. You know, it's kind of a cyclical market, and they've already kind of gone up a lot recently, but they have a really good looking price chart for the last decade, and their dividend yield is the highest out of any of my growth stocks at over 3%. Now, their payout ratio is a little higher than I'd like it to be at 58%, but for me, it's not a deal breaker because their average growth rate is really good at almost 20%. The only other concern is that they've only been growing those dividends for the past 4 years, which is much lower than I'd like it to be, although they have been paying dividends since 2004. But because they manufacture chips for several large companies, and that's including the upcoming 7nm chips for AMD, which to me is a huge deal, I feel that it's worth investing in them just as a long-term dividend growth stock as well. Okay, before we wrap everything up, let's take a look at some common dividend stocks, and then we'll make some comparisons as well. So here's a stock that I mentioned in one of my 3 stocks to buy videos, and that's Aflac. And this one looks pretty damn good from a dividend growth perspective. Their yield is at 2.2%, their payout ratio is fantastic at only 25%, and their dividend growth history is absolutely massive at 36 years of consistently growing those dividends, which is very impressive. The only downside I see here is that their 5-year growth rate is much lower than I'd like it to be at only around 5%. So it may take you a while to really build up Aflac's dividends, but just their history and their payout ratio alone tells me that these dividends will probably keep growing for a very, very long time. Okay, and here's another popular dividend stock, and this one is Texas Instruments, and this one also looks really good as a dividend growth stock. Now, they have a yield at almost 3%, a pretty reasonable payout ratio of 54%, and a 5-year growth rate of almost 25% with 14 solid years of dividend growth. So to be honest, this one looks really attractive to me as a dividend growth stock. Okay, next up is the stock that we mentioned earlier when we were talking about Warren Buffett, and that's Coca-Cola. Now, Coke is a really good dividend stock for stable income, but it doesn't really fit the bill as a dividend growth stock. They do have a very nice yield of 3.4%, and they have an enormous 56 years of growth, but their payout ratio of 75% is much higher than the other stocks that we looked at earlier, and their growth rate is also much lower at only 7.7%. And on top of that, their price performance isn't very impressive considering that we've been in a decade-long bull run where, some stocks have been up like 1,000% or more. Coca-Cola has only been up around 100%. So, I think that this is a relatively safe stock, a relatively safe dividend stock, but I definitely wouldn't consider it a dividend growth stock. Plus, I'm also a little skeptical about their future with everybody turning against sugar lately. And to be honest, I think I like PepsiCo a lot more than Coca-Cola anyway. So anyway, that's my thoughts on that. Okay, and another popular dividend stock is CVS. Now, they have a solid yield of 2.5%, a payout ratio of only 28%, a really nice growth rate of 25%, and a very nice 15 years of growth. So all of that looks really good, but the only problem is that their price performance has been pretty poor for the last few years, so I'd be a little cautious with this one. Make sure that you really do a lot of research on them before considering that one. Okay, and the last dividend stock that I want to pull up here is Procter & Gamble. This is a dividend stock that a lot of people feel offers some crash protection because even though it has technically dropped during the last few crashes, it actually raised their dividends and recovered pretty quickly as well, so the rides were a lot less painful. Now, their yield is very nice at 3.5%, and they have one of the biggest growth histories around with a massive 62 years of growth. But their payout ratio is a little high at 65%, and their growth rate is also very low at only 4.4%. On top of that, their price performance for the past decade is mediocre at best, and most recently it's been kind of all over the place, so it doesn't really fit my type of portfolio. Alright guys, so I think that just about wraps it up. Now, you probably noticed some comparisons there. The type of stocks that I usually invest in have much lower dividend yields, but they also usually have much lower payout ratios as well and a lot of growth potential. So just kind of keep that in mind and let me know what you guys think. Make sure to leave a comment down below. If you want to see more educational videos like this one, then make sure you're subscribed and hit the like button, and I will catch you guys in the next video. Have a wonderful, beautiful day and take care. Bye-bye.